Hi, and welcome back to Money Managers, a User's Guide. I'm Nathan Peters. This week, I'd like to introduce a relatively niche but growing strategy in liquid alternative funds, event-driven. Kepler has a useful graphic on their website, link in the description below, where they outline the size of the UCITS liquid alternative world. And we see that event-driven funds make up about 6% of industry assets with about £12 billion. What do I mean when I say event-driven? Well, it means literally that the prospective returns on offer in the strategy have more to do with whether or not corporate events, such as mergers or acquisitions, occur, rather than the operating performance of a given company. A classic example is that in a merger between two companies, if you go short the acquirer and long the target once the deal is announced, the residual uncertainty and time value before the transaction is consummated usually offers up an attractive risk-reward, especially if the deal dynamics are poorly understood by the market. This strategy can be valuable for portfolios as most of these trades are 1. Self-liquidating, so if shares are tendered for, you are taken out of the trade without having to transact in the secondary market. 2. They're uncorrelated to the wider market, although extreme market events can affect the spreads these strategies target. And 3. They exhibit positive carry, that is, most of the time you're making money. Negative aspects of the strategy include 1. Leverage used to magnify spreads is a double-edged sword, so your research better be correct. And 2. When deals break, the resultant stock price action is typically rapid and violent, exhibiting the dreaded left tail or negative surprise. Much of the alpha from this strategy comes from dynamic sizing based on probabilistic conviction. That is, you need to be able to actively trade the deals as new information comes to light and spread pricing evolves. Generally, passive implementation of this strategy, which attempts to harvest a risk premia by playing every given deal subject to some liquidity or implementation constraint, hasn't been very successful over time. Okay, but why should I care now, you may ask? Well, the world's sharpest, shortest ever recession, followed by its fastest, largest ever rebound, is creating a huge wave of strategic M&A, combined with financial sponsor M&A, as private equity assets seek to deploy dry powder. As soon as the C-suite was able to look through a post-vaccination normalized demand picture, it was game on for animal spirits. And we are seeing the results of this directly in the alpha levels we are getting in event-driven strategies. More deals than capital means wider spreads, greater inefficiency, and greater prospective returns. But how does the landscape look in terms of the event-driven funds available in the marketplace? What can people actually invest in? Is the alpha trickling down to UCITS funds and not just the big multi-strategy firms that move capital in and out of this strategy? We've taken funds with substantial AUM and pedigree into account and have come up with a list of 11 UCITS funds here. I'll include the tickers in the description box below. The spread of returns over the common period from October 2019 to the 12th of May 2021 is large, with a range from up 2.5 to up 11.5 almost. But longtime viewers know we don't just look at headline returns. If we put all these funds together in one pot and regress its returns against the Venn factor lens, we see a rise in alpha generation after the COVID crisis in March of 2020 and accelerating again this year. Managers on the ground described March of 2020 as the worst spread widening scenario they'd ever seen, and for good reason. You'd think if ever there was a trigger for a material adverse change clause to an agreed upon deal, a global pandemic that mothballs the global economy would be it. But lawyers are crafty, and contracts were enforced, keeping the wheels of capitalism moving, as did central banks' largesse, of course. And dedicated event funds have been one of the beneficiaries ever since. But which ones were the best? Well, over this period, it looks like Man GLG, Lumina, PSAM, and BlackRock Global Event Driven made the most money. But if you take a look at the return from equity beta, here, these are also some of the funds with the most market exposure. And regular viewers know that managers shouldn't get credit for that. So which fund earns the most from its wits, from correctly sizing and hedging the events themselves? And the winner here goes to Kite Lake Event Driven, with the only double-digit annualized alpha result. And if we go to the Kepler site for that fund, we see a steady performer overall, not large at all in comparison to some of the other less distinguished funds. Funny what you can unearth when you look beneath the surface just a little. And that's all from me today on Money Managers, a User's Guide. If you found this content interesting, please like, comment, subscribe, and hit the bell for notifications. And remember, use your money manager. Don't let them use you. Thanks.